It took less than 30 minutes. A single social media post from a political figure triggered a seismic wave that liquidated billions and sent Bitcoin into its biggest plunge ever. On October 12th, the crypto world saw a $19 billion wipeout in hours, sparked by President Trump's announcement of 100% tariffs on Chinese tech exports. Bitcoin dropped 8.4%, but the real story was the cascading liquidations. Over 1.6 million traders wiped out in less than an hour. For a market built on decentralization, this vulnerability to geopolitical events is a harsh reality, exposing leveraged traders to global political risks. The crash raised questions about suspicious trading activity, with reports of a $200 million short position on Bitcoin placed just before the announcement. Was it foresight or insider information? This is a critical issue of market integrity that every trader must consider. But why does Washington's drama impact a global asset like crypto? The answer lies in the trillion-dollar debt. As of late 2025, U.S. government debt is around 124% of GDP, with interest payments projected to hit $1.8 trillion annually by 2035. This debt crisis drives policy, and policy drives crypto. New levers and control are needed. The idea of using crypto to pay off debt is a fantasy. Even in the best scenarios, it could only cover 1.3% to 5.3% of federal debt over a decade. But crypto can still play a role. As a long-term store of value, a source of tax revenue, and a means to modernize payments. The real game is regulatory clarity. A supportive political environment can act as a tailwind for the market. The classification of crypto, currency, property, or security determines its taxation and utility, impacting its price. In 2021, a former president called crypto a threat, but by 2024, he embraced it, showcasing a fundamental shift in market narrative. When a major player changes their stance, the market reacts, proving that political narrative drives price. The hidden costs of crypto are real. Inflationary pressure, tax leakage, and energy consumption are ticking time bombs for future policy. So, is the crypto market being manipulated? Not in a simplistic way, but it is influenced by public policy and geopolitical tensions. For investors, the message is clear. Regulatory intelligence is the new fundamental analysis. Watch the Fed, the debt, and understand the tether to centralized power. You think you're trading based on solid facts? Think again. In today's market, a single tweet can shift billions. Welcome to the era of the Trump pump and dump. This isn't just politics, it's about power and profit. We're diving into real events to expose the playbook. You need to know how to spot this cycle and avoid the crash. Let's break down what the Trump pump really is. It's market manipulation through policy and presidential power. The pump comes from erratic announcements, the dump from reality. We've seen two flavors, policy panic and direct asset hype. First, the policy panic, a clear example from April 2025. A sudden tariff announcement sent the market into chaos. Those with insider knowledge profited while others panicked. Next, the direct asset hype, the Trump coin phenomenon. A meme coin skyrocketed thanks to social media buzz, but when insiders sold, retail investors were left holding the bag. The conflict of interest is clear. Policy meets personal profit. So how do you protect yourself? Build your investors' armor against the Trump pump and dump. Ask, who profits first from sudden political announcements? Look for social media hype over genuine fundamentals. Understand that volatility is the product, not stability. In this new financial landscape, track the political shockwaves. The Trump pump and dump teaches us about power dynamics. Your job is to analyze motives, not just trust the hype. Protect your capital and be the analyst, not the anecdote. If this opened your eyes, hit like, share, and subscribe. Stay vigilant. Stay profitable. See you in next video soon.